Okay. Wow. Great to see so many people here today. Thank you. We appreciate it. Good afternoon and welcome to Increasing the Value of a Private Company. My name is Mike Ryan and I'm president of Emerge M&A. We've been confidentially opening markets and selling private companies across every industry since 1989. We know what buyers look for and how they look at private companies. We're going to share that information with you today. With me is our Executive Vice President, Dwayne Gentry.
Hi, everyone. Thanks again for joining us today. There's quite a few people on the webinar, and we appreciate your time. We're going to be sharing a tremendous amount of information with you, so I want you to hang on tight. In addition to our M&A experience, both Mike and I have owned and operated businesses in the past. So I can tell you that I wish I'd known a lot of this information when I was building my company some 25 years ago. If you have any questions as we proceed and give the information to you today, just please feel free to type them in the confidential chat and we'll address as many of these as we can after the webinar. Be sure to know that only we can see who's sending in the questions. Your identity is not visible to any other attendee, and it's only visible to us. So you can also ask questions using the anonymous question function if that's preferable.
Thanks, Dwayne. We know your time is valuable, and we plan on providing 14 action items in the next 25 minutes that will hopefully change your lives. But before we get specific, let's set the table. Most owners have a considerable amount of their net worth tied up in their private company, yet they don't know what it's worth, and it's harder to sell than a publicly traded share of stock. And you still have more risk, and you're working 24/7, 365. Even if you're not physically present at the business, it's always present with you. If your financial advisor brought you a stock and asked you to invest most of your net worth in that stock, couldn't tell you how much the stock was worth, or if you could sell it, or at what price, would you buy that stock? Probably not. Yet every day you go to work at your private company, you're doing the same thing. Most businesses have life cycles. They typically start with the owner bootstrapping the business from the ground, working day and night to make things happen. At this point, the business is in survival mode, but eventually migrates to what we call a lifestyle business.
Yeah, and a lifestyles business typically provides for the owner's needs with the owner working in the business, generating revenue and things of that sort. But at some point, the owner migrates from working in the business to working on the business. And working on the business, the owner is now installing operating systems, procedures, staff, and a management team. So instead of directly generating revenue working in the business, the owner is managing employees, management, and systems that generate the revenue. At this point, the business is now institutionalized. Buyers purchase private companies for two primary reasons: return on investment and risk mitigation. Buyers will look for a company to acquire that has something very special that the owners created that they can scale. And they'll usually do that with their unlimited checkbook and their management bench.
Thank you, Dwayne. A company that has moved beyond the lifestyle phase and is now institutionalized also has other factors that led to the success of the company. These factors, the magic of the company, the secret sauce, if you will, needs to be documented and explained in such a way that the buyer will see minimal risk and maximum upside opportunity, thus increasing value. Before we get specific, the attributes we're about to discuss apply to all privately held companies. For example, we're going to talk about customer concentration and how that affects value. A CNC manufacturing company may have fewer customers than a residential HVAC company, but the point being, everything we're going to discuss today applies to all companies in every industry.
Right. And by the way, everyone, we have industry reports that address certain value enhancers specific to most industries. So if you have some interest, please type your name in the confidential chat and we'll be happy to share this information with you.
Great. Okay, let's get specific. Customer concentration, having fewer customers that make up a large portion of the business. Remember, buyers buy company for ROI and risk mitigation. The possible loss of those customers provides significant risk profile to the buyer. Many owners in this situation feel that those few customers are stable and never going elsewhere for the products or services provided by their company. Maybe, maybe not, but the perceived risk is still ever present and that will affect value. Now, we had an owner of an engineering outsources company who had 7 customers. But of those 7 customers, 5 were separate entities but covered under one master service agreement. As much as that owner thought those customers were never leaving, guess what? One day he got the call and 81% of his business was gone, never to return. In addition to customer diversity, in some industries, the type of customer impacts risk mitigation as well. For example, trade-based companies that depend heavily on repeat business from general contractors appear far riskier to buyers than companies that sell directly to business owners or consumers. Having a diverse customer base, such that the loss of any one customer will not materially impact the business, will increase the value of your company.
Thanks, Mike. Let's talk about owner dependence. When a business is heavily dependent on its owner for the day-to-day operations and decision-making, it can create risk and uncertainties for potential buyers or investors. I'm going to tell you just a few ways in which the lack of owner dependence can impact the value of a private business. The first is scalability. If the owner is the primary driver of the business's success and is involved in every aspect of its operation, it may be difficult to scale that business without their active involvement. This can limit the potential for growth and expansion, which will negatively impact its value. The second is continuity. When a business is highly dependent on its owner, there's a risk that the business may suffer if the owner becomes unavailable, becomes sick, or decides to leave. And thirdly is transferability. If the owner's skills, knowledge, licensees, or other relationships are critical to the business's success, it may be difficult for a new owner to replicate those factors and maintain that same level of performance. Now, conversely, a business that has a second-tier management team in place is perceived as much more valuable. The business can run very well regardless of whether the owner is present. This increases the business's potential for growth, for scalability, and long-term sustainability, making it much more attractive to potential buyers or investors. So overall, reducing owner dependence is essential for increasing the value of a private company. And now finally, value is increased significantly by having clearly defined roles within the management team. Written job descriptions, an organizational chart, and periodic job performance reviews are amazing. So in addition to the perceived continuity of the business, these things demonstrate a company that has been institutionalized and is therefore more valuable.
Thank you, Dwayne. Patented or proprietary products and services. Now, we know not all companies have patented products or proprietary processes, and that's all right. There are thousands of valuable private companies without patented products or some sort of proprietary process. But having patented or proprietary products or services can significantly increase the value of a private company in many ways. Patented or proprietary products provide a unique selling proposition that sets the company apart from its competitors. It gives the company an advantage by offering something that others cannot easily replicate or imitate. This can lead to higher market share, increased customer loyalty, stronger brand positioning, ultimately driving revenue growth and profitability. For example, we sold a company last year that developed a proprietary sales process, which provides sales and revenue contract for medium-sized manufacturing companies across the country. Although the company only employed salespeople who worked remotely, and it did not have a physical office, it sold for millions of dollars because the proprietary sales process was deemed valuable by multiple buyers. The proprietary product or service gives the company greater control over its pricing. It can charge premium prices for unique service offerings as customers are willing to pay more for exclusive or innovative products, increasing profits, and which in turn increases the company's overall value. Finally, patented or proprietary products contribute to a strong brand reputation. They demonstrate the company's commitment to innovation, quality, and unique solutions. This differentiation can attract customers who value exclusive or cutting-edge products, leading to increased market value.
Thank you so much, Mike. Let's talk next about management information and operating systems. There's an old saying, you can't manage what you don't measure. So management operating systems, CRMs, ERPs, and the like are more important than ever to the buyers, rather, of private companies. These systems not only facilitate efficient operations, but also increase profitability while providing important information for in-the-minute decision-making. Buyers are going to prefer companies with the latest operating systems already in place. So if a company has an outdated system or no system at all, that can represent a lot of heartburn, a lot of risk and agitation to the buyer. This can result in a lower purchase price and value.
Thank you, Dwayne. It's no secret there's a shortage of competent labor in every functional discipline. This shortage in the employee base is only expected to get worse as time progresses. The longer an employee stays at a private company, theoretically, the more competent and stable that employee has become. A more competent and stable employee will be more efficient and hence create more profitability within the organization. Buyers will look at a company's employee longevity and compare it to their overall industry. If your employee longevity exceeds employee longevity in your overall industry, that will increase value. Employee longevity increases profitability and stability of the organization, creates less perceived risk to the buyer, and therefore increases value in the marketplace.
Thank you, Mike. Growth in the company's industry. This is a little bit granular, but I think it's important that we note it. So no matter how well a company is run, how great its intangibles are, and how great its metrics are, if there's no growth in the company's industry, it creates a lower value in the marketplace. For example, a company may maintain a niche within a certain industry and have great metrics within that industry and that niche. But if it's in an industry that's contracting or a no growth industry, that company will be less valuable in the marketplace.
That's right, Dwayne. Thank you. Minimal capital expenditures to hit financial growth projections. Many factors and metrics are considered when a buyer goes to acquire a private company. One of those metrics is EBITDA, which means earnings before interest, taxes, depreciation, and amortization. Buyers will acquire and pay premiums for companies which can demonstrate growth potential substantiated in financial projections. The key is to develop projections based on certain metrics that can be substantiated. Often growth potential includes many intangibles which are inherent to the company and not on the balance sheet. However, if a company is fully equipped and the need to spend money on infrastructure to achieve those growth projections is reduced, that company will have a greater value. The buyer must spend money to build out the infrastructure in order to achieve financial projections and growth. That company will be worth less in the market.
Thanks again. Let's talk about quality and safety programs. Now, up until about 15 years ago, buyers didn't pay that much attention to quality and safety programs, believe it or not. But since the advent of quality of earnings reports as part of due diligence, which by the way, Mike's going to talk about in detail later, quality and safety programs have become more important than ever. Buyers expect to see quality and safety managers and written procedures in place within a private company. With return on investment and risk mitigation as key factors in determining market value, quality has become more critical in the marketplace, and as has safety with respect to mitigating workers' comp qualifiers and, of course, general workplace safety for their employees. Now, if your company is a little smaller, it's not essential to have a manager for these areas, but someone in the company must bear these responsibilities as part of their written job description. And then last is, not last, but similar to owner dependence is key person dependence. So dependence on key people can greatly reduce the value of a private company. This applies to not only salespeople, but also operations and management people. So lack of key person dependence will ensure continuity of the operation for a buyer, reduce transition risk and integration risk, and of course, enhance stability. In addition, the company will be more likely to be viewed as having scalability and a higher growth potential. As I mentioned earlier, depending on the size of your business, having a second and even third tier management team in place and having institutionalized systems to drive the business makes it less dependent on one or two people. This is going to reduce the risk for the buyer and thus increase the price that they're willing to pay.
Thank you, Dwayne. No supplier dependence. Maintaining a diverse group of suppliers will increase the value of a private company. Limited or single source suppliers, regardless of the stability of that supplier and the relationship between the private company and the supplier, there's still great perceived risk on the buyer in such situations. When I first started my career, fax machines were critical to business, and I won a major contract with a nationwide bank to supply fax machines. A huge coup at the time. 2 days later, that major international manufacturer of those fax machines decided to leave the market. No one saw it coming or could have predicted it. Point being, supplier dependence creates a perceived risk, and a broad supplier base increases value. Market defensibility. There are certain factors that create barriers to entry and provide the company with a competitive advantage, making it difficult for others to enter the market and compete effectively. Although there are many factors, we're going to focus on 4 right now. Unique intellectual property. We've already discussed this, so we're not going to park here too long. Companies that hold unique intellectual property, such as patents, trademarks, copyrights, trade secrets, have a stronger market defensibility. Strong brand and reputation. A company with a strong brand and reputation in the market enjoys market defensibility. A positive reputation for quality, reliability, customer service also acts as a barrier to entry, as customers are more likely to choose a trusted brand over unknown alternatives.
Yeah, that's so true, Mike. I owned a trade services business many years ago. We spent a lot of time and a lot of money creating our brand. So for many years, we were viewed as the market leader, and this was well before that was actually the case. That brand reputation allowed our company to outpace our competitors and scale our business quickly in that market.
Yep. Great job. High switching costs is a big one. Companies that can create high switching costs for their customers have a competitive advantage in market defensibility. Switching costs refer to the costs and difficulties associated with customers switching to a competitor's product or services. This could be due to contractual agreements, integration requirements, or the need for specialized knowledge or training. High switching costs make it less likely for customers to switch to competitors, protecting the company's market share. And lastly, strong customer relationships. Companies that have strong relationships with their customers enjoy market defensibility and increased value. One key here is to develop some metric of documenting when it comes time to sale, to document the metrics of that customer loyalty and those customer relationships. So as you run your business, think of ways that you can document a metric that can be shown to a buyer, showing that strong customer relationship. It should be noted here that for customer relationships need to be between the company and its customers, and not the owner or a key individual within your company and the customers. Relationships between the company and the owner are not transferable at sale, since the owner is leaving at some point. But relationships between the customers and the company in general are transferable at sale and thus increase value. Non-competition and trade secret agreements is an important factor as well. If a buyer or investor buys or invests in a private company, as discussed, ROI and risk mitigation are the critical factors and driving force. Many of these factors are tangible, others intangible, many real and many perceptual. As discussed, customer retention and business continuity after sale are critical in increasing the value of a private company. Non-competition or trade secrets agreements with employees are perceived to protect the company. It's the customer base and therefore the business continuity, reducing perceived risk and increasing value. Now, as an aside, owners are encouraged to get these agreements in place well before considering an eventual sale. We have seen situations where a buyer, late in the closing phase of an M&A transaction, insists that certain employees have non-competition agreements. Now you've got to disclose to your employee that a sale is pending and confidentiality is sacrificed. Worse yet, now you present a non-competition agreement to that employee, who then tells you will have to have his attorney review it with you, and get back in touch. Now, everyone knows a transaction is imminent and it's delayed by the employee and their attorney trying to negotiate that employment agreement. We've seen this happen, and it's not pretty, so please get any of those agreements in place right now.
Thanks, Mike. Now, this is kind of boring, but we're going to talk about it anyway because it's very, very important. Financial metrics within industry standards. Certain industries have general financial metrics such as gross profit, net income as a percent of revenue, and the like. While all private companies are even those in the same industry are different, they all should somewhat fall around those same industry financial performance metrics. For example, an HVAC company that does new construction and service will yield, say, 11 to 13% recast net income. A service-only HVAC company will yield 19 to 24% recast net income. They're both HVAC companies, although their business is different. So if a service-based HVAC company is throwing 12% recast net income instead of the 19 to 24%, it's going to have a lower value. This is true regardless of the industry. So all industries have those financial metrics. If a private company exceeds those general metrics, that company will garner much more interest and therefore have a higher value than those that fall below those same metrics.
Yep, for sure, Dwayne. High quality of earnings grades. About the last 12 years or so, buyers are all engaging certain credentialed CPA firms to develop quality of earnings reports as part of due diligence in the closing phase of an M&A transaction. Up until 10 years ago or so, due diligence in the closing phase was much simpler and basically involved matching the P&L to the tax return to bank statements. Please realize that's an overly simplified statement. A quality of earnings report does look at financial information as provided to the buyer, but also delves into all aspects of the company, including everything previously mentioned in this webinar. All characteristics we've discussed pertain to return on investment and risk mitigation. The quality of earnings report goes beyond just financial data to look at other factors that pertain to ROI and risk mitigation, operating systems, CRMs, ERPs, employee longevity, safety, quality, no owner dependence, no key person or supplier dependence, no customer concentration, management teams in place, market defensibility, customer satisfaction, and environmental compliance. None of these issues are financial in nature, yet a buyer and their CPA developing the quality of earnings report will look at them all. The CPA firm will then literally create a quality of earnings report containing a grade for your company. The higher the grade, the more valuable the company.
Thanks, Mike. Now, everyone, we've thrown a lot of information at you, and we recognize that each company and each industry is different. However, installing as many of these characteristics as possible will definitely increase the value of your private company. I really appreciate you attending today. We both do, rather, and we hope that this was helpful to you.
Yeah, and it should be pointed out that we threw 14 points at you and some subsets within those points, and we recognize that the perfect company doesn't exist. But if you can install as many of these criteria as we've discussed today, it could make a difference of millions of dollars for you in company value. So Dwayne and I are going to stand by now, and I'm going to see what questions are coming at us, and we'll stay here and answer any questions you have. Here we go. How long does it take to sell a private company? Dwayne, you want me to take that one, or do you want that one?
I can take it, Mike. In general, it takes 8 to 12 months to sell a private company. And that's, of course, dependent on how quickly we're able to get information from the seller. But in general, that's the average time it takes to sell a private company, from the time you say go to the time there's a closing and the check is written.
I think the important thing to understand here is, we've sold a private company in 88 days. We've sold it in 92 days. But from a planning standpoint, it takes about 8 to 12 months to go out there and create competition. And competition is the key. Competition amongst buyers is the key. We did a deal recently where we had 7 offers that drove value up 42% in one afternoon. So it takes about 8 to 12 months from beginning to end. And the reason that's important to owners is oftentimes you think, well, today I'm ready to sell. Well, guess what? It's going to take 8 to 12 months for that to happen. And the question is not whether you're ready to sell today, but what can happen in those 8 to 12 months that can affect the market and affect you. So that's really a planning metric. So just to be clear. Okay. How are interest rates increasing, affecting the market for private companies? I'll take that one, Dwayne. So typically what happens is when a buyer buys a private company, they put about 50% of their own money in, and then they borrow 50%. And before interest rates started going up, we'd see them all doing term loans. So for example, they put down 50% and then they borrow the other 50%, pay interest only. No principal, interest only on a 5-year loan, which means that they had a lot of flexibility in their debt service. Ever since interest rates started going up, what we're seeing is buyers now, instead of borrowing that other 50%, what they're doing is putting 100% of their own money in. So in the market underneath $200 million in mergers and acquisitions, we've not seen a decrease in values or activity. In fact, we're in the busiest market ever for privately held companies we've ever seen, with some of the highest values being paid. Let's see. Oh, we talked about installing some of those characteristics. Oh, here's one for you, Dwayne. I'm thinking about buying a company now. How would that affect me selling my company at some point? And this is a question we see a lot, folks. And right now we're in a seller's market, and Lord knows how long that seller market is going to last. So if you're thinking about buying another company, there's a lot to think about. First of all, you're buying in a seller's market. Okay. Second, then there's going to be some risk of integration. You may not be able to integrate that company and take advantage of that combination of your two companies for a year, 2 years, 3 years. Now, what happens if 1 or 2, 3 years after you're starting to get some of the benefits, your acquisition comes along and the market tanks? You know, what did you do to yourself? Conceivably, at that point in time, your company was worth less money than prior to you buying the other company. So we kind of in this market, in this time frame, counseling against, people going out and buying other companies, not owners of private companies buying other smaller companies vis-a-vis our buyers. Our buyers are corporate and institutional, so this type of thing wouldn't affect them. And I don't see any more questions. Anybody any more last minute questions? I don't see any hands going up, so it must mean we did a good job, Dwayne.
Yeah, well, thanks everyone for joining today. Please reach out to us if we can assist you as you plan for the future. Plan on building your company. We're here to help. We want to be an informational resource to folks. And that's why we put this webinar on today. So we hope you guys have an amazing day, and we hope to talk to you again real soon.
Thanks, everybody.
Thanks again for your time.
Yeah.